the Mastery Mindset podcast channel. The Wealth Series. Master your mind and unleash your potential. Welcome to another episode of the Mastery Mindset podcast channel, your go-to source for mastering risk management and safeguarding your investments. I'm thrilled to have you join us today. Today, we're going to take a closer look at the critical topic of risk management. It's a subject that's absolutely essential for anyone in the working age who's looking to secure their financial future. So, let's get started. First things first, let's delve deeper into what risk truly means in the context of investments. Risk can be compared to the ever-changing weather. It has a tendency to shift unexpectedly, but that doesn't mean it's beyond our control or understanding. To help illustrate this concept, let's consider a practical scenario. Imagine you're in the midst of planning a long road trip. The weather forecast for your journey predicts rain, possibly heavy at times. Now, here's where the parallel to investing comes in. In this situation, you face a choice. You can either decide not to pack an umbrella and hope for the best, or you can choose to be proactive and prepare for the possibility of rain. Let's explore both options to grasp the significance of risk management. Option 1. Risky move. Imagine you opt not to pack an umbrella. You might think, it's just a possibility of rain, and I'll take my chances. While this choice seems carefree, it's essentially akin to not diversifying your investment portfolio. By not preparing for potential downfalls, you expose yourself to unnecessary risk. Just like you might get soaked in a sudden downpour without an umbrella, you could suffer significant financial losses when market conditions turn unfavorable. Option 2. Managing risk. Now, let's consider the alternative scenario. You decide to pack an umbrella in your travel bag, acknowledging the potential for rain. This simple act demonstrates your risk management skills. By preparing for the unpredictable weather, you're taking a proactive approach to safeguard yourself. Similarly, in the world of investments, managing risk means being prepared for various market conditions. Just as having an umbrella in your bag ensures you stay dry when it rains, having a diversified investment portfolio ensures that you're better equipped to weather the storms of market volatility. It's all about being prepared for whatever comes your way and not leaving your financial well-being to chance. So, as we delve deeper into the topic of risk management throughout this episode, remember this fundamental principle. Just as you'd pack an umbrella for a rainy forecast, you can take steps to protect your investments and secure your financial future. Certainly, let's delve deeper into the intricate world of risk by exploring the different types of risks that can affect your investments. You see, it's crucial to recognize that not all risks are created equal. Each type of risk has its unique characteristics and potential impact on your financial well-being. To better understand these risks, let's draw an analogy that relates them to real-life scenarios. Think of it this way: investing in the financial markets is like riding a roller coaster. There are exhilarating ups, thrilling downs, and unexpected twists and turns. Now, let's break down the types of risks using this analogy. 1. Market risk. The roller coaster ride. Market risk is similar to the ups and downs of a roller coaster. Just as a roller coaster's exhilarating climbs and sudden drops can be both thrilling and nerve-wracking, the stock market experiences fluctuations in prices. These price swings can affect the value of your investments. Market risk is essentially the uncertainty of how your investment will perform due to factors beyond your control, like economic conditions, geopolitical events, or industry trends. 2. Credit risk. Lending money to a friend. Credit risk is like lending money to a friend who might not pay it back. When you lend money to someone, there's always a chance that they won't repay you as promised. Similarly, when you invest in bonds or extend credit to a company or institution, there's a risk that they may default on their debt obligations. Credit risk highlights the importance of assessing the creditworthiness of the entities you invest in, just as you would evaluate your friend's reliability before lending them money. 3. Operational risk. The smoothness of the ride. Now, let's discuss operational risk. This risk can be likened to the factors that determine how smoothly your roller coaster ride goes. When you invest in a company, you rely on it to operate efficiently and effectively. Operational risk encompasses all the potential hiccups a company may encounter, from management issues to supply chain disruptions. Any disruption or inefficiency within the company can impact its profitability and, in turn, your investment returns. Understanding these different types of risks is crucial because they all play a role in shaping your investment journey. Just as a roller coaster ride can be a mix of thrilling highs and stomach-churning lows, your investment portfolio will have its share of ups and downs. In the following segments, we'll explore strategies to help you navigate these risks and make informed decisions to secure your financial future. Now that we've gained a solid understanding of what risk is and the various types of risks that could impact your investments, it's time to roll up our sleeves and explore practical strategies for effectively managing these risks. To illustrate these strategies, picture yourself as a seasoned ship captain navigating through a stormy sea. In this challenging environment, your success hinges on a few key principles. 1. Solid plan. Just as you'd chart a course and set a course of action for your journey at sea, you should have a well-thought-out financial plan for your investments. This plan should outline your goals, risk tolerance, and the path you intend to take to achieve those goals. Having a clear plan in place will provide you with direction and help you stay on course even when the financial waters get rough. 2. Sturdy vessel. Your ship, in this case, represents your investment portfolio. Much like a ship captain ensures their vessel is sturdy and well maintained, you should diversify your portfolio across different asset classes such as stocks, bonds, and real estate. Diversification helps spread risk and minimizes the impact of a downturn in a single asset or sector. 3. Well-trained crew. A competent crew is essential for smooth sailing. In the investment world, this equates to your knowledge and understanding of the financial markets. Investing isn't a passive endeavor. Staying informed and continuously improving your financial literacy is crucial. This can involve regularly monitoring your investments, keeping up with market news, and seeking professional advice when needed. Just as a ship captain combines these elements to navigate through stormy seas successfully, you can employ similar strategies to navigate the financial storms. Diversification. Spread your investments across various asset classes and sectors to reduce the impact of a downturn in any one area. Thorough research. Before making investment decisions, conduct thorough research. Understand the companies or assets you're investing in and their historical performance. Stay informed. Keep a watchful eye on the financial markets. Understand the broader economic landscape and how it may affect your investments. By implementing these strategies, you'll be better equipped to weather the financial storms that can arise during your investment journey. In the upcoming segments, we'll explore more strategies and tools to help you master risk management and safeguard your investments effectively. Now that we've covered some fundamental strategies for managing risk, let's dive deeper into a crucial aspect of risk management: asset allocation. Think of asset allocation as the meticulous process of deciding how to distribute your ship's resources among various critical aspects of your journey, such as navigation, maintenance, and cargo. To make this concept more tangible, consider a scenario where you're planning for retirement. This phase of life is akin to embarking on a long and potentially treacherous sea voyage, and your asset allocation strategy becomes your roadmap to a successful journey. Imagine your investment portfolio as your ship, and within it, you have different compartments representing various asset classes. These compartments might include low-risk assets like bonds and high-risk assets like stocks. Just as a ship captain carefully allocates resources to different aspects of their voyage, you must decide how much of your resources go into each compartment of your investment portfolio. For instance, you might allocate a portion of your investments to low-risk bonds. This portion provides stability and serves as your ship's steady navigation equipment, ensuring you stay on course during calm waters or financial market turbulence. Now, let's consider the other portion of your investments allocated to higher-risk assets like stocks. These assets can be compared to the cargo you're carrying on your voyage. While they come with more significant risk, they also have the potential for higher returns. Just as a ship captain wouldn't put all their resources into a single aspect of their journey, you shouldn't concentrate all your investments in one asset class. By diversifying across low and high risk assets, you spread your risk and increase your chances of a successful financial voyage. Asset allocation isn't a one-size-fits-all approach. It should align with your financial goals, risk tolerance, and time horizon. By carefully balancing your investments in this way, you are essentially charting a course that accounts for both the calm seas and the turbulent waters you may encounter during your financial journey. As we continue to explore risk management in the following segments, remember that asset allocation is a powerful tool in your arsenal, allowing you to navigate the uncertain seas of investing with confidence and balance. As we continue our journey through the realm of risk management, it's essential to understand that managing risk isn't a one-time task. It's an ongoing and dynamic process. Think of it as akin to the continuous vigilance required when checking the weather forecast during a road trip, and making adjustments to your plans accordingly. To illustrate the significance of monitoring and adjusting, let's dive into a practical scenario. Suppose you've invested in a company's stock because you believed in its growth potential. However, over time, you start noticing signs that the company's performance is declining. This situation is akin to seeing dark clouds gather on the horizon during your road trip. Now, what do you do in both cases, with your investments and your road trip? You take action. Just as you might decide to change your travel plans, seek shelter, or adjust your route when bad weather looms, in the world of investments, you should monitor the performance of your assets and be ready to make adjustments when necessary. In the context of your investments, this might mean re-evaluating your portfolio, conducting a deeper analysis of the company in question, and considering whether it's time to sell your shares or reallocate your resources. It's all about being proactive and responsive to changing conditions in the financial landscape. Remember, the financial markets are constantly evolving, and unexpected events can impact your investments. Monitoring your portfolio and making necessary adjustments is your way of staying ahead of potential financial storms. Just as checking the weather forecast allows you to make informed decisions on your road trip, staying vigilant in the world of investments can help you avoid major financial downpours and setbacks. So, the key takeaway here is that risk management is an ongoing commitment. By continuously assessing, adapting, and making informed decisions, you can navigate the unpredictable nature of the financial markets with confidence and resilience. As we wrap up today's episode on mastering risk management and safeguarding your investments, remember that it's all about preparation, diversification, and staying vigilant. In conclusion, the path to financial security is not a straight line. It's filled with twists and turns, just like a journey. But with the right knowledge and strategies, you can navigate those curves and come out on top. Thank you for tuning into the Mastery Mindset podcast channel. If you found today's episode valuable, please don't forget to subscribe, hit that like button, and share it with your friends and colleagues. Your support means the world to us. And if you have any questions or topics you'd like us to cover in future episodes, please feel free to reach out. We're here to help you on your journey to mastering risk management and securing your investments. Until next time, remember, the mastery of risk management is within your reach. Stay safe, stay informed, and keep investing wisely.